Hello, Ian. Hello, Winning Investor Nation. How are you today, Ian?
I'm doing well. Happy Monday, Amber. How's it going? How was
I'm,
the weekend?
all is well. I'm recuperating from what can I call this? A wedding weekend. So a
Oh,
lot of
those are always
family.
fun.
It was a good time. So I'm happy to be here today, though.
Well, congrats to your family.
Thank you so much. Thank
Mhm.
you. How was your weekend?
It was good. Just the usual doing stuff with the toddler stuff.
I know that can keep you well occupied.
Yeah.
So, Ian, actually, I post wedding, I had an opportunity to find this really fantastic report I was reading just yesterday, and I thought I'd share it
Mhm.
with everyone just to give you a really great heads up on what we can expect, especially with the stocks we follow. So, there's actually a great shift that's happening that is nearly guaranteed to have a very positive effect on our recommended industry 2.0 stocks, our
Mhm.
company stocks, especially in strategic fortunes, Ian. So instead of procuring products from countries far, far away, a new study has found that corporations are changing their mindsets and are now turning to producing and procuring products for all type of industries regionally. The key word here is regionally. So this is great news for robotics, for automation, and of course 3D printing company type stocks. And a survey by McKinsey and Company that reached out to 113 supply chain leaders worldwide, representing organizations from a broad range of industries. Well, they found that the regionalization of supply chain resilience measures is gaining steam. Simply put, nearshoring or reshoring is becoming a real solution for corporations in a post pandemic world. So boosting in-region sourcing is now key. And as McKinsey and Company puts it, quote, the turbulence of the past 2 years has forced many organizations to address vulnerabilities in their very complex, highly globalized supply networks, end quote. So, Ian, I just have to say, as this chart shows, I have to show everyone this chart. 44% of respondents, up from 25% last year, an even larger relative jump, say they are developing regionalized supply networks. Most companies are planning significant keyword here, significant changes to their inventory management strategies over the next 3 years. Keyword here, 3 years. So they're looking for smarter ways to ensure supply chain resilience while keeping inventory costs under control. And 90% of companies surveyed say that they plan to revise inventory management, well, their strategy in the advanced electronics as well as high tech market. So that's what's in this chart. So finally, as the Council on Foreign Relations frames it, quote, the pandemic has really accelerated a whole set of forces, reshaping global trading ties. Robots, automation, and 3D printing increasingly mean many businesses can do more with fewer workers, making cheap labor relatively less important. So, Ian, I would really love to hear your take on this finding in this survey. It's really telling and bodes very well with our vision of the future and what's going to happen not too far from now.
Yeah, this is something I've been talking about for a couple of years, Amber, is
Mm-hmm.
that if you look at what the world did basically 40 years into COVID, right? So start in 1980,
Mm-hmm.
which was a big year for the United States in the sense that Reagan took over and it was morning in America and it allowed companies to really start. That was the beginning of globalization, right?
Mm-hmm.
Like
Right.
companies started paying lower taxes. They were doing more investments overseas, and that
Mm-hmm.
continued throughout the Clinton presidency in the 90s and then throughout George Bush in the 2000s.
Right.
1980 to 2020 was really the age of globalization.
Mm-hmm.
And it was characterized by the growth of emerging markets. If you look at Brazil, Russia, India, China, the BRICS, so-called BRICS, they had amazing decades. And one of the reasons was because that the United States and other developed economies throughout Western Europe were offshoring production to these areas because the cost was cheaper. Since then, in the last 40 years, you've seen an increase in labor costs as these countries, specifically China, has seen their middle class grow. Okay,
Right.
so 40 years ago, an average middle class participant in China, the per capita annual wage was like $1,000 a year. Now it's close to 10,000. So the Chinese middle class has grown, most prominently because of the offshore investments that developed economies have made.
Right.
I think that the COVID crisis, which showed us how fragile these supply chains really are, really sparked a change in that. And you're seeing it on the political front in a lot of countries where it's like, we want to have more jobs here in the United States. And companies are also realizing that, their supply chains are at risk if they're sourcing everything from other countries that, they could potentially get cut off one way or another. So I think we're changing from an age of globalization to an age of deglobalization. And that's going to have a lot of impact on the economics, how that works. I think that inflation right now obviously is 8%. I don't think we're going to get back to 2%. I think the Fed is going to be okay with a higher rate of inflation. They'll probably pivot towards, 3 to 4% is what we're looking for. Because I think that inflation becomes more structural when you're talking about sourcing goods in the United States or in developed economies. The key here, though, is how can these companies stay competitive? And a big part of that is going to be how they use and implement technology in a lot of the companies that we're investing in to produce goods in the United States in a manner that could be cost competitive with how they were producing them overseas. And, I just think that this is such an enormous trend that's going to happen over the next decade. This reshoring of production here in the United States. You and I have been talking about this, for at least 6 months, if not, even I was saying it during COVID about these supply chains. And, the McKinsey survey really backs it up. So the bottom line, there are some companies in automation and robotics, and I would say some of these self-driving truck companies, even though Too Simple had a little bit of a hiccup last week,
right,
that are going to be at the forefront of this here at the change, especially in the United States, in the same way that there were companies that helped offshoring production throughout the 80s and 90s that, did tremendous. Now we're going to start to see deglobalization where companies are producing things in their home country as opposed to when they're producing it overseas. And I would say if there's one thing that left and right sides of the aisle in America agree upon, it's bringing more jobs back to the United States. On the far left, you have Bernie Sanders, right, who is all about having stronger unions and bringing jobs back to the United States. On the right, you've got Trump and other politicians who also want to do the same thing, encouraging investment in the United States. And I would also say, the CHIPS Act under Biden is doing this, where it's bringing back, it's basically subsidizing the building of new semiconductor plants here in the United States, so that we can have that production here. We don't have to rely on, it's Taiwan essentially, but you have to rely on whether or not what China is going to do with Taiwan. And I think there's a lot of investments that we're making now that have national security implications, because we need to produce certain specific materials and semiconductors in order to have the type of future that we're looking for here in the US. And, we've identified a number of companies. Off the top of my head, I can say MP Materials is one of them that makes magnets, the material needed for magnets, which is involved in all of these very high tech electric vehicles and drones and anything electronic. So, this survey is just further showing us how important it is, and the fact that these companies are pushing for it now more than anything else.
That's right. I couldn't agree more. Excellent analysis there, Ian. And it's just something that's going to happen. We just have to wait and be ready with our investing. And speaking of investing, actually the companies that stand to gain from this great supply chain shift, like robotics, automation, 3D printing, et cetera, are actually represented in Ian's Strategic Fortunes Research Service. So if you'd like to gain access to these particular stock tickers and future recommendations that are on our radar for a 2.0 world, well, please click the bull icon right here over my shoulder to get all of those details. So Ian, pretty good stuff there. It's fascinating. Ian, talk to me. I'd like to hear what you're thinking on crypto this week. You were mentioning a tweet that you saw that you like to share with everyone regarding.
Yeah, so I just want to share the co-head of venture at Brevin Howard Digital. Now, Brevin Howard is a massive hedge fund. They probably have 20 to 30 billion assets under management. They're involved in all different types of strategies. and they've actually been growing their digital presence, which digital is basically code word for crypto in the institutional space. And one thing that he shared, and something that I've been talking to crypto subscribers about, is that BNY Mellon, which is, you know, one of America's oldest banks, it was founded famously by Alexander Hamilton. They did a survey of 270 institutional investors. 97% agree that tokenization will revolutionize asset management.
Okay.
And you can't have, you know, tokenization means essentially like, if you're going to tokenize these assets, then decentralized finance is going to play a huge role, because it makes it cheaper to create all types of derivatives and swaps and these, you know, sophisticated financial products that the banks used to take a little bit of a fee out of every transaction. In this case, you know, you can run everything on the blockchain and run it all autonomously. The other thing is that 88% said they're planning to move forward with current plans around digital assets, despite the market downturn. So that just tells you that, you know, there's going to be a significant bid from these institutions in the crypto space. And I think you've kind of seen it lately, because like Ethereum and Bitcoin have done better than the stock market has the last couple of months. They also said 88% are comfortable with stable coins. 49% would be willing to forego overnight yield on cash deposits to send domestic payments basically whenever they wanted, which is what you can do with the blockchain. Because, you know, if you're a bank or an institution and you want to send a wire, you have to do it when the Fed wire is open. With stable coins, you can just do that 24/7, 365. And, you know, just as of note, we have Veterans Day on Friday. You know, that's great. It's a holiday. Let's celebrate our veterans. Stock market's open, bond market is closed, right? So there'll be no trading in the US government bond market. Whereas like when everything's tokenized, there'll be no holidays. If you're an institution and you want to trade something on Christmas Day and everything is tokenized, there'll be a market for it. Whereas, you know, I know it's like we need to have holidays, et cetera, but eventually I think it's a more fair, open, you know, marketplace when things can trade 24/7, 365. It's kind of silly that you can't make an investment on the weekend just because the stock market is closed. And lastly, I just want to leave with this, is that Bank of New York Mellon, which did the survey, has already launched Bitcoin and Ethereum custody for their institutional clients. It's something that I've also been talking about in my crypto service as well. It just goes to show you that the banks are not offering these services to attract institutions, is that the institutions are demanding it because they want to invest in the digital asset space. They see the tokenization coming and they want to be at the forefront of it. So to me, that just means there's going to be a continuous bid in crypto from these institutions in a way that, you know, a lot of investors in crypto have been hoping for the last couple of years. Now it's finally here.
Okay, well, there you have it. And I'm glad you mentioned your crypto service, Ian. Of anyone who's interested in learning more about how Ian views the crypto market and what he recommends, I highly suggest you check out his New Wave Crypto Fortune service. And you can also click the link here over my shoulder, the bull icon, to get those details as well. So
awesome.
Good stuff, Ian. Thank you for sharing that crypto news. So last, I like to share one more megatrend tidbit that I think really should be on our radar. So a relatively new concept is set to transform factory production as we know it. Now visualize factories. Now think of this. I want everyone to get ready for flex factories. Just like how we may subscribe to Netflix and Spotify through a subscription. Well, producers of products may soon subscribe to a factory. Per Boston Consulting Group, flex factories means, quote, instead of owning facilities that manufacture its products, a producer pays a usage fee to share a highly flexible factory with other companies. To make the arrangement financially attractive, third-party investors actually own the assets. So in a nutshell, this is the concept called production as a service, or PaaS, production as a service, end quote. And its market, Ian, could actually reach approximately $70 billion to $100 billion globally per Boston Research, while the annual manufacturing value added by PAAS sets up could actually reach approximately $720 billion to $900 billion in the coming years. So in my Megatrend Thursday webinar, I find this very fascinating. I'm going to post this video on our YouTube channel on Thursday this week. I'm actually going to pair Bloomberg analysis to share which companies actually can stand to gain from this potential trend of looking into flex factories and factory production in a new way. So please stay tuned for that video. But how do you feel about flex factories? Have you?
Well, first of all, the name production as a service, so PAWS, like
yeah,
there already is a PAWS. I don't know if you know the Easter egg coloring PAWS
yes,
company.
of course, yes.
Yeah, okay. So I was hoping they'd call it FAAS, Factory as a Service, FAAS.
Oh,
I think it's great. You know, it reminds me of if you ever tried to start like a web company or like an e-commerce company like 20 years ago, it was so expensive. It literally would cost you $100,000 because you had to like go get servers. You had to like hire a full-time developer to build a website. You had to hire a back-end developer to do the shopping cart checkout.
Right.
But nowadays, if you want to start an e-commerce company, you literally just go to Shopify and pay, you know, $100 a month and they do everything for you. So it's really interesting that we're now at the point that if you have a great idea of something you want to mass produce, and let's say, you know, you do a little sample and people want to buy it, you can actually quickly scale that without having to build your own factory. And I think that in ways that it unlocked a lot, like the fact that you can do these, set up a Shopify account and sell e-commerce has allowed so many entrepreneurs to basically, you know, build a business for much cheaper. And this led to more innovation. I think that it's going to lead to more innovation on the production side as well, which to me is like super exciting because, you know, we need more American ingenuity. We need more innovation, especially on the production side. So I think that is just like great news all around. And I believe it'll lead to like a wave of, you know, new ideas, new products here built in the United States, because the cost of producing things is going to be a lot cheaper than going to build your own factory and your own, you know, robots and everything like that. So I love the idea, 100%.
Oh, 100%. I am there with you on that one, Ian. I'm just fascinated. So I look forward to seeing what can be cobbled together through Bloomberg analysis. So Ian, that's what I have for this week. Anything more on your radar that you'd like to cover before we sign off?
I mean, we got a busy week. We have, of course, the election, the midterms on Tuesday. And, you know, the market is still digesting the jobs numbers from last week. And then you got Michigan consumer sentiment that comes out Friday. I think the big number this week, obviously, is going to be the CPI. I think the market, my prediction is that the Republicans are probably going to win the midterms if they win the House, maybe not the Senate. And I think that is going to lead to more economic optimism here in the United States, probably better off overall because we'll be in gridlock for the next couple of years. So it's better for the market. The market likes gridlock essentially, because you don't want to have one party that controls everything that just starts changing things. And then, you know, the CPI is going to be key. If the number comes in much hotter than expected, I think expectations are 8%. It beat last month, which was not good for the market. If we do see a 7 handle this month, I think things, you know, we could see a continuation of this rally that we've seen so far. The most hated rally of the year is what we've been looking at. Everybody hates this rally, which is normally a good thing. So I do think that the market's going to continue higher one way or another. We probably, you know, double tested those lows that we hit early this summer. It looks like a double bottom. And, you know, traditionally we're heading into seasonally one of the strongest times of the year. We could end the year out with a nice little Santa Claus rally. So that's what I'm looking for. And all this will be confirmed if we see a CPI under 8%. If it's like 8.5% or 9%, then, you know, look out below.
Okay. All right. Well, fingers crossed on a good 7 handle or so CPI number. Well, Ian, thank you for your insights. Thank you, everyone, for joining us today. And I'd just like to remind everyone, if you'd like to follow Ian and me on Twitter, Ian can be found at Invest with Ian, and I am at A Lancaster Guru. And of course, please remember to subscribe to this channel and give us a thumbs up if you do enjoy the content.
We're almost 10,000 subscribers.
Oh, isn't that exciting?
That's right. Well, we're going to do a big giveaway to the 10,000th person. So,
Yes, yes, yes.
and also we're going to select some random commenters who comment every week to give you something special. And you know who you are. Thank you for participating and making this channel fun.
Oh, yes. Thank you, everyone. We couldn't do this without you. So thank you for your support. Well, for me, I wish you all a good week ahead. Alex is still asleep. Is he there? Yeah. So he wishes you a good week too, Ian, and everyone watching.
Awesome. Thanks all.
Thank you. Bye-bye.